Hey guys and dolls, and welcome into another video. Wow, we have such an amazing video today lined up for you guys and dolls. I just watched a full interview of Cathie Wood on the Rouse Report and it was absolutely mind-blowing. The conviction that that woman has right now for disruptive innovation compels me as an investor. I feel so inspired. I can't wait to share some of the leading clips that I found in this interview to be key points and super helpful. So make sure to watch this video the entire way through. You do not want to skip anything because every single line and every single minute, every nuance of this video has key points that are essential for long-term investors. And I really believe in her disruptive innovation, how it's going to change the world and how we as investors are going to capitalize on this opportunity moving into the future. Now, my name is Jason. If you are new to the channel, I just want to say welcome, hit that big red subscribe button and hit that like button if you find value at any point in the video. Now, we are actually seeing some kind of correction and Cathie does go on to explain what she's doing to manage her portfolio in times that are hard like this. And guys, I just want to say and put it back up there that I'm not worried at all about the volatility in the markets. Cathie Wood sees this as an absolutely amazing opportunity to buy the dip and hold for the long term. So I'm just going to start by playing you this clip right now.
Well, in a sell-off, any sell-off, we will concentrate towards our highest conviction names. So during the coronavirus, for example, the crisis, we went down to 33 names in our flagship portfolio. Today, we're up to 55. So what we will do in an extended correction is we will concentrate the portfolio once again to the top 30, 35 stocks, because those are the ones in which we have the highest conviction, and it has been that conviction has been growing over time. In fact, when we started the firm in 2014, it took a lot to get people's attention because they thought we were too risky, too crazy. And I see now it's coming full circle because I hear that again, but it's much less risky than we believe the benchmarks are. The benchmarks are filling up with value traps because the innovation platforms, there are 5 of them, and they involve 14 different technologies that are all taking off right now. They are going to disrupt and disintermediate the traditional world order. So I think the big risk is in the benchmarks, not what we're doing. So if you talk to most analysts and portfolio managers, they're really focused on the next year or 18 months in terms of guiding their buy and sell decisions. We are not. And in fact, we want our companies to sacrifice short-term profits in order to be in the pole position to win in many of these winner-take-most markets. Artificial intelligence is causing a lot of winner-take-most markets. The companies with the best data, the highest quality data, are going to win. Tesla in the autonomous taxi network world is one of those examples. So by definition then, if our companies are investing aggressively now for going short-term profits, the valuations are going to look very rich. And that's probably the biggest criticism we get. It's on today's valuation, next year's valuation. If you give us 5 years, however, and given the exponential growth rates we're talking about, say 82% growth on average per year in the electric vehicle market, if you give us that, we are managing value portfolios. I truly believe that. Now, as you know, Tesla wasn't going to have earnings for another, I think, 10 years. Yes, going against the grain. In fact, sometimes when the sentiment is so negative and we have good reason to believe that something differentiated is going to happen, unexpected, those are great times. You know, I call them the valley of death. It's a saddled S-curve. The first saddle S-curve, it's kind of a fake out, too much money chasing too few opportunities too soon. That was the internet late 90s. Then in the mid 2000s, early to mid 2000s, valley of despair. Nobody wanted anything to do with these stocks. And then that's a great time to pick up stocks. And right now, 3D printing stocks have been there for a long time. And then you enter the sweet spot of the S-curve and it's unstoppable.
So I love Cathie Wood and everything that she is saying right now about all of these little tips about staying diversified and how she is managing right now in a time of crisis like this where we do see those corrections. And if you do find value, then be sure to give this video a like. Now guys, Cathie Wood's conviction for Bitcoin is also super bullish. She believes that Bitcoin is going to go to 400,000. So I do want to play you another clip onto why hedging money against inflation by buying a digital asset like Bitcoin is so important in times like today, where the Fed continue to print more money and stimulus continues to be pumped into the economy. So let me play you this clip.
We are very optimistic about Bitcoin in particular. And I think the big surprise to us, we had been expecting more institutional or professional interest meaning institutions starting to put it in their funds, and to see Mass Mutual put $100 million of Bitcoin into the general account. Do you know how many hoops that an insurance company would have to jump through to be able to do that? Now, it's only 0.001% of a general account. However, just to get it in there, unbelievable. What has surprised us is the diversification that companies like Square, Tesla, and MicroStrategy, the diversification into Bitcoin on their balance sheets. They are starting to build their cash positions. Can you believe 2 years ago, people thought Tesla was going to run out of cash? Now it's built its cash positions to such an extent that it's diversifying about 8% into Bitcoin. I think it's a great insurance policy. It makes a lot of sense. And it's not, meaning if we go into an inflationary period, cash will lose its purchasing power. Bitcoin will not. In fact, Bitcoin, as you can see recently, is gaining purchasing power pretty dramatically. It's what's called a deflationary currency. All that means is your purchasing power goes up over time. And so I think more innovative, tech-savvy management teams are saying, why don't we diversify? What's the reason not to diversify? And so I think this is going to happen more broadly. That's a very big deal. So Tesla put 8% of its cash. I think Square's up to 5%. MicroStrategy, all of its cash. And if all the corporations in the United States were to do that, somewhere in the 5 to, well, let's just say the 1 to 10% range, just diversifying into Bitcoin, that would add anywhere from $40,000 to $400,000 to the Bitcoin price. So it would double the Bitcoin price at a minimum. If it were only 1% diversification, it would push the price up almost 10 times.
So why is Bitcoin so important? If you don't know much about Bitcoin, I would highly recommend to watch this video above that I have done a full breakdown on why I'm so bullish on Bitcoin, why it is 10% of my holding. I do have 10% of my assets right now tied up in crypto because I really believe that Bitcoin is going to go up to £100,000 by the end of the year, which is going to easily see a double or triple up on the current price from where it is sitting right now. Cathie Wood also goes to talk on about how mainstream TV adoption is going to die out, and services like Roku are actually going to be the winners. And that is why I also want to play you this clip right now about Draftkings, which is one of our plays that is actually up over 25% since I did mention it on this channel about 2 months ago. So congratulations if you are holding that stock. I am still super bullish, and she says why this is going to be one of the #1 stocks in the stock market for sports betting.
Well, we do think sports betting is losing its taint. Draftkings is becoming a platform for sports betting. States in crisis with huge deficits are going to capitulate one after another. And then one of the most mature betting states, New Jersey, DraftKings reported last week, its revenues were up 100%. Again, this was another stay-at-home beneficiary, so people said, we're going to get back to life as usual. This is going to be part of life as usual, and so New Jersey was very telling to us, and we do believe that it is a platform strategy in the space.
So Cathie Wood is saying that she believes that the DraftKings are going to be the #1 in the gambling space. So this makes me really, really super bullish, and I'm super excited to still continue to hold DraftKings into the future. Now, Cathie Wood did go on to say as well in the videos that she expects an annual return of 20% on minimum every single year of her assets for 5 years. So that is at least a double up, guys. So that is something to pay attention to. Any of her stocks in her ETF, she does have a lot of research that have gone into them. And if you just want easy plays, then just simply go onto ARK Invest and look at some of those stocks individually and break them down. So the last 2 little clips that I just want to play you is about the streaming service, her conviction on Roku, and how she thinks and believes, would you believe that Zoom is still completely undervalued in the market? This may actually blow your mind.
Well, Roku, everyone asks, okay, there's a huge transition from linear TV to streaming TV. And what would you invest in, or where would you invest given the $70 billion of linear TV advertising dollars that are going to disappear and go somewhere? Where would you invest? Most people would say Facebook, Google. We would say a lot of people know that. That is no surprise. The surprise is Roku. Roku is becoming the operating system of streaming TV, of connected TVs. It and Amazon are in competition, so to speak. But Roku put its own channel. It has started its own channel and is starting to buy content for it. Quibi is one example. It has just moved on to Amazon's platform as well. So we think those two, certainly in the United States, are going to take the lion's share of the connected TV market. And Roku Roku is moving internationally and is finding really good success, and I think that's an upside that many people don't anticipate. It's mind-blowing. Most stay-at-home beneficiaries, the stocks, they peaked in the summer last year. Zoom was cut in half from $600 to nearly $300 last week. Got the earnings report this week, and most people have been saying, okay, yeah, we're kind of getting back to normal. They got to slow down. Its growth rate accelerated from 365% year-over-year growth to 369% year-over-year growth, a $900 million run rate, which is $3.6 billion annualized. That's what people's estimates are for 2021. They're wrong. It's going to be much higher than that. The world has changed. And I think Zoom is it's playing in the largest part of the technology stack out there, the $1.5 trillion telecommunications part of the stack. And I think it's going to usurp a lot of the old telco infrastructure. So I don't think people understand that. So we're pretty excited about it, and actually like that the sentiment right now is so negative. People think this stock at about $110 billion is selling at an outrageous multiple to sales. It is not if our estimate for this year is right. In fact, it's probably undervalued. I know people think that's outrageous, but stay tuned.
Again, I hope you did find value in this video. If you did, then be sure to give this video a like, share it with a friend, and hit that big red subscribe button. I just want to say I appreciate you if you did make it this far. Thank you for your continued support on the channel. I hope to see you back on my channel for some more content soon on investing. Stay safe and don't forget to have your cup of tea. Ciao.